Today we're going to be talking about how exchanges can leverage technology and product strategy to tap into new liquidity sources. We have distributed slides for this and you can download them online, so if you haven't got them already, please do so. My name's Hirander Misra. I'm the Managing Director of Misra Ventures, which is an exchange consulting and advisory firm, and I'm joined by my colleague Tony Harrop, who's the Managing Director of Forum Trading Solutions, which is an exchange trading and technology firm. If we flip to slide 2, today we're going to talk about products and technology, and initially we're going to focus on the state of the world market in 2012. Following on from that, the challenges that exchanges face, and then how exchanges, both in developed and developing markets, can rise to that challenge by way of the product roadmap and potential technology roadmap as well. And then just finish with concluding remarks on that and address any questions that you may raise during the webinar as well. So moving on to slide 3. Increasingly, markets are getting more complex. We all know that. That's the obvious thing. Whether it's from a product perspective, whether it's increasingly over the last few years been from a technological perspective as well. We've obviously seen in equities a global rise of alternative trading venues. I had the privilege of being part of that from Chi-X days in 2007 onwards. We've then seen some consolidation across those equities alternative venues. The exchanges also react in terms of competition, responding and innovating in response to that competition as well, and some acquiring those venues like the LSE, the London Stock Exchange acquiring Turquoise, that's global markets in the US, then acquiring Chi-X Europe as well, and some venues not succeeding because of over-competition. So NASDAQ, MX Europe, for example, having to close down. Others like quote NTF not having a lot of volumes. We're also now, beginning to see, so the equities market, we're beginning to see lower volumes as well. But now actually the focus is shifting. Obviously equities is an important asset class, but the focus is also shifting to other asset classes. We've got MiFID II and the European Market Infrastructure Regulation in Europe that's going to lead to OTC derivatives coming on exchange and being centrally cleared. We've got the Dodd-Frank Act and all its directives in the US that also sees that movement with the advent of alternative swap execution facilities, i.e. alternative venues in the US, and the advent of potentially more multilateral trading facilities and organized trading facilities in Europe as well. So over the next few years, we're likely to see a proliferation of alternative venues. But equally, the exchange space is very interesting because we've had recently NYSE and ICE talk about potential acquisition of NYSE by ICE, and equally other failed merger approaches last year with Deutsche Börse and NYSE falling through and not being approved by the regulators in Europe. But you'll certainly see exchange consolidation, economies of scale there, because exchanges are looking to become increasingly global and cross-border, especially the larger ones. But equally, we'll continue to see some of those go beyond their markets. So the CME are coming into Europe as far as the exchange launch is concerned, beyond CME clearing in Europe. And we're also seeing NASDAQ launch LLX on interest rates swaps. And equally, we'll see, and there are currently a range of other initiatives across the exchange alternative space. Technology is an interesting one because, of course, we'll see product innovation on the back of regulatory change, OTC markets that we've just spoken about, but also we're likely to see technology be a key driver of that beyond just capacity and latency, which Tony will speak about, but also looking at how we can innovate and use that technology to enable the business, which is key in all of this. We've also seen high frequency trading increase in the US and then following that increase in Europe as well, and we're also seeing that more globally in other markets that are developing, but at the same time there seems to be a regulatory witch hunt around some aspects of that. But equally around high frequency trading, we're seeing a move away from just latency arbitrage to alpha generating strategies, because those that have just been focused on latency and latency arbitrage just don't survive. You actually need a liquidity provision and alpha generating strategy there to survive, which is also good for the market as a whole. So that trend will manifest itself more and more. And moving on to the next slide, we've already addressed the expanded asset class trading, be it interest rate swaps, moving on to exchange futures on those OTC products, moving on to an exchange environment, whether it's futures products that mirror the underlying swaps market, or whether it's FX related index products, as well as sovereign debt potentially moving on exchange with new initiatives in that space as well. And in the fixed income market, you've got the likes of Vega Chi trying to challenge the existing exchanges both in Europe and the US as an alternative venue. We're also seeing regulation as key to all of this. So obviously in the US and Europe, you've got more common regulatory drivers, and in Asia you've got independent regulatory regimes, but nonetheless some of the Asian markets with the ASEAN trading initiatives are trying to harmonise some of that, albeit under separate regulatory regimes. And regulation remains a key driver, because even those markets that have independent regulatory regimes are looking at what's happening in Europe and the US, and we've got effectively bank balance sheets being constrained and capital being at a premium, being key drivers to some of those centrally cleared products, and harmonisation across around regulation as well, be it regulation around algo trading and be it regulation around central clearing and interoperability around clearing as well. There's also a need for differentiation. Whether you're an exchange, you need to differentiate, because, for example, India is a typical market where there's a range of equities markets now with the NSE as a primary pool and the Bombay Stock Exchange, but you're also now seeing the launch of MCXSX. You've got some of the regional markets that also want to relaunch, and a lot of these markets where there is competition need a unique selling point. They need to differentiate themselves. So yes, focus on equities, but we all know the number of listings generally, especially in developed markets, is going down. Listings revenues alone can't drive profitability alone, and so you need a defined secondary market strategy to help drive that. Increasingly there's a backdrop of competition. I mean, typically exchanges used to be very much focused on their home market, and we had competition where effectively the MTFs came in and European exchanges had to become more pan-European on the back of that. Equally, you've got obviously the CME example that I cited with US exchanges coming into Europe, using that as a gateway into Asia. The Asian exchanges like Hong Kong coming into London with the acquisition of the LME. So it's very much a cross-border competitive play as well, and it's interesting how developing and developed market exchanges cope and adapt to that. And you're also seeing, especially equity markets, we've seen a commoditization of that. So will we now see that in derivatives markets and OTC products as well, with narrowing spreads, and also technology proliferating from the sell side to the buy side too. So, that kind of sets the backdrop reasonably well. Now, if we look at the state of the world market 2012, you've got to ask the question, is technology really okay? We all know that it's an important enabler. Some of the larger exchanges have become technology companies first and foremost, and they've, even NYSE have looked to then garner increasing level of profits from technology, more so than transaction-based revenues, given there's been some decline there. But we've also seen a number of high-profile glitches. These are just some of the headlines we pulled off the internet. With there's been high-profile ones like the Facebook IPO on Nasdaq, Knight's problems, effectively on the market-making space, other exchange issues, with NYSE in Tokyo as well. Now, Tony, I've got to ask a question to you. Again, focusing on technology, are we really okay on technology? Does something need to change? Why are we seeing more outages than before? Is it because exchange systems have become more complex? What's your view on this?
So certainly you're right, they're becoming more complex, but it's key to always remember that it's always the bad news that hits the headlines. These things shouldn't happen. It's not always just technology, it's often process. There's some well-known case studies out there where things happen because people didn't follow a formal control process. They released code out into production that haven't been properly tested. Of course, things are going to go wrong if people do that. So yes, systems are becoming more complex. I think people's understanding of them, and we'll come to that point later on, has to be commensurate with the level of technology as well, and that's often a problem. But do bear in mind, 99.9% of the time, systems do perform well. But of course, when they do go wrong, they go horribly wrong.
Yeah, and it's almost like being in goal. If you play football or soccer, you can make a number of saves and then you let in a howler, and everyone remembers the howler, and they don't remember the 10 saves that you made before that as well. So in many ways, but then we've got to acknowledge we're in a high availability of environment, and there aren't any prizes for getting it wrong. If we look at now more succinctly the challenges that exchanges face, we know developed markets, it's obvious when their home markets are under competitive pressure, exchanges have to respond to that. And CME example we've cited, Nasdaq as well, given the diversification away from primarily in equities revenue base. So the key challenge is how do you become more global, because it's easier said than done, but whilst at the same time innovating in your home market, protecting your existing flows, and then also innovating on the back of products and making that product more globally applicable. It's a challenge, frankly, that still hasn't been solved in its entirety. If we look at that, we've got some like Chi-X Global trying with the establishment of market centres in Canada with its ATS, in Tokyo with its PTS, for example, as well. In Australia with the alternative venue, again very much equities focused, and and some markets are very difficult to get into. If we look at China for alternative venues, even India where there's ownership limits on exchanges as well, and equally I'm sure someone like Chi-X Global would love to get into the US and European markets as well, but then it's increasingly difficult with a competitive environment across asset classes there. So how do you come in with the right product sets and the right unique selling proposition? Obviously CME have taken the view that getting into Europe, that's a good gateway then, mid-time zone into Asia, and even though they've got regional offices and a point of presence out there in the likes of Singapore, maybe on the back of regulatory change, solve Europe first, and then use that as a catalyst as Asian markets further develop to then take that product set into Asia. One of the issues that you have there is, okay, even with the same venues, you have very disparate clearing. So obviously Nasdaq with NLX have decided to use LCH ClearNet Limited. In the US you've got a different clearing regime with DTCC for equities and OCC on the options side. The issue there is effectively cross-margining across all those products and getting economies of scale there, but also especially where we mentioned capitals constrained, how we get a harmonized collateral pool so that clearing members, whether they're direct clearing members or general clearing members, can get economies of scale from that and do more with less. One of the ironies of this regulatory change is it was intended to reduce systemic risk in the market, but we're likely to see a proliferation of clearing houses in Europe, all with their own open interests on contracts, all with their own silos, all with their own margin and collateral requirements, and it actually puts more strain on the system in the short term rather than less, although we suspect there'll be some consolidation there as well after some competition. Now if we move to emerging markets, they face a challenge of how do you develop your domestic capital markets whilst also having access to the global ecosystem for both primary market listings but also secondary market liquidity. So we know that large trading players, be it the banks or the trading houses, are all active on the larger markets, as are the clearing firms, as are all the major vendors. Now, if you're an emerging market trying to set up and you've got a small number of listings, it's almost chicken and egg. You've got a small number of listings, you've got to develop those and then further develop your equities market. You can only do that if you try and attract inward investment and also try and attract liquidity. But that inward investment and liquidity doesn't come unless there's existing liquidity and inward investment there. So one of the issues which we'll discuss is how do we solve that challenge, and then also with that backdrop, how do you adapt to regulatory change? Because absolutely, there's independent regulatory regimes in each jurisdiction, but investors and traders need to be confident in each independent, emerging market that the system works, that there's credibility around the system as well. So if we move to slide 7, again, keeping that focus on emerging markets, how do we deal with this? We've spoken about the low level of liquidity, the initial low level of listings. In some cases, not all regulatory institutions that need enhancement, infrastructure bottlenecks, because technologically some of these exchanges from a trading, clearing, settlement perspective have to be more automated as well. And also there needs to be a more retail investment culture, because even in India, huge population, over 1 billion, well over 1 billion people, yet equities ownership accounts for between 1 and 2% of the overall flow on the retail side. And so the government wants to grow that as well, but how do you encourage that in an environment where traditionally that type of investing, like the US, hasn't been prevalent? You have larger exchange solutions out there, but typically the way that I see that is, to a large extent, they're very much technology focused, although some are trying to change that and bring in other products, and it's very much not connected into the central ecosystem of liquidity either. So it's very much siloed. So there's an exchange deployment, that's great, but then how does that relate into better product development? How does that relate into hooking into the central liquidity pool? I think looking at this with a helicopter view, what's needed is more a ethical and sustainable model where these exchanges are interconnected. And I think the ASEAN idea is not a bad one, but that also needs to be taken one step further as well. So if we move to slide 8, we look at current setup for any typical emerging market is a domestic exchange. You've largely got domestic players. There might be the odd institutional player in some cases there might be restrictions, like in India, unless you've got a local presence, for example, foreign institutional investors need to come in via an online, via a domestic broker, and remote membership isn't permitted, for example. So, the domestic exchange is very much a silo, and again, it could be standalone as a single exchange, or citing the Indian example, there could be an environment of competition where there's multiple exchanges as well. But it's very much siloed. It very much has its own clearing, whether it's in that single model or even in India where the NSE, the BSE has its own clearing, MCX has its own clearing, across asset class, in other asset classes a separate clearing as well. All that doesn't lead to good economies of scale. So how do we change that? The future really is enhancing liquidity and interconnectivity via a hub. So exchanges interconnecting is the first step. We'd argue here physical interconnectivity isn't enough. It's relatively straightforward to put in a physical line from one exchange to another, but what does that really achieve? Having application level connectivity is the next step, but there again, we know, looking at the Car East example of a Pan-Asian dart pool, obviously it was single site, but merely making something Pan-Asian or making something Pan-Latin American isn't sufficient, because you've got to look at the overall business drivers and the overall product and liquidity drivers as well. So exchanges interconnecting with other exchanges, whether it's developing exchanges connecting with developed market exchanges or with each other, there's definitely merit in that, because that opens up the client base of all those exchanges. But then you've got to look at, okay, how do you look at cross-membership easily as well and tap into those clients, because it's great if they're connected, whether it's via FIX for those less latency sensitive, or via independent binary protocols for those that are sensitive, which Tony will speak about. But equally, how do we harmonize some of those membership rules? How do we harmonize some of the regulatory rules? Also, how do we harmonize some of the clearing? And how do exchanges offer instruments that are traded on each other, or trading on each exchange on each other as well? And then harmonize the clearing model around that. Typically what we found in emerging markets is some of the sort of emerging markets initially are very commodities focused, and the first step is how do we automate our commodities exchange. The next step typically is, okay, our equities market needs further development, we need to attract inward investment, both in primary and secondary markets. How do we do that? and then look at derivatives as extending that into other asset classes and leveraging that expertise. And we'd argue, there is a model out there successfully that can interconnect these exchanges, and there's no one-size-fits-all model. But certainly in terms of that evolution across asset classes, which we'll speak about, on the next slide, there is an opportunity in that regard for these exchanges to interconnect. We're already seeing the developed market exchanges have experience diversify, and we've spoken about those already, effectively cited on the slide. And then let's look at the key priorities for emerging markets. So facilitation of listings is one. Equally, in certain emerging markets, India being an example, the state corporations that the government want to bring onto exchange, whether it's via ETFs or whether it's via part listing some of these ventures. So how do we facilitate that with the right framework? How do we promote institutional investor flow through greater transparency and market integrity, and also foreign flows through remote membership and foreign participation? Because you don't want to effectively create a barrier to entry, but then some exchanges are also challenged with the fact that many of their members are domestic members as well. So at the same time, you want to create an environment that doesn't disintermediate those, but also brings in foreign players and improves the overall market, increases volumes, and ensures that the market benefits from greater depth and greater coverage and instruments as well. And the key to all of this is how to enable that with efficient trading, clearing and settlement and depository infrastructure to tap into that liquidity and market integrity enabled by technology, which Tony will talk about. And it's a given that, to promote that integrity, you need strengthened supervision and investor protection as well, because if people are unsure about the market or they have questions about the regulatory regime, they're not going to invest and trade either. Now, if we look at slide 11, an extension for that then, that's looking at it standalone. You then encourage regional integration, so you track flows from each other and improve liquidity through economies of scale and interconnectivity and product development. ASEAN being an example, but you had others like the Turkish exchange talk about an MOU with Egypt. Now, an MOU is great, but how do you then put that into practice by encouraging cross-border flows? And we know the traditional cross-border flows in developed markets like the US and Europe, there's very much a seismic shift to some of those flows now being to Asia and between Asian markets as well. As an example, we're seeing that play out in Latin America as well with some of the collaborations there. How do you then develop beyond equities into the corporate and government bond market? There's many markets there emerging where there's a huge secondary market debt play, and the governments in some of these markets, for example, the finance ministry in India as well, are looking to cultivate those markets. So how do you do that? How do you then develop innovation on that? So ETFs on the back of indices that are developed, tradable index and derivatives products, mutual funds, commodity products, both to tap into the existing physical ones that develop electronically, but also others that are cash settled as well, and effectively how you leverage the expertise of existing markets as well and all that knowledge, because a lot of the answers are normally out there. It's horses for courses as well in any given market, but we're not talking about reinventing the wheel here as well, or square peg round hole. We're very much talking about learning lessons from those around us and then tapping into that with an innovative approach, and moving forward on that basis. So now I'll kind of hand over to Tony on technology, because at a high level we've spoken about some of the products there, but how do we enable all of that with technology, Tony?
Okay, I've put together just a few slides that hopefully get across some of the initial ideas and thoughts that have certainly been going through my head. It's very hard in a few minutes on a webinar to get all the detail across, so please feel free to come and approach us at the World Exchange Congress and hopefully carry forward some of these conversations. The first one I wanted to put up there is a lot of the press in the last few years has been about low latency technology. Everything has been around doing it faster, better, more of it, pushing it through at high frequency and so on. But that doesn't solve the problem. There's no golden bullet out there. And actually what we're starting to see is a trend that, yes, accepts that as a part of the architecture, but actually wants to move towards what I've termed a lean architecture. So what do I mean by that? Well, traditionally, every platform had 20, 30, 40, 50, 60 servers distributed across different sites, different environments that would link together, that would distribute parts of the application. Because code is now more efficient and is leaner in itself, it can actually run faster and actually makes use of that low latency speed. It can actually run on a smaller hardware footprint. Why do we want to do that? Well, clearly any decision ultimately comes down to cost, and one good reason for doing this is it means it can run on a much lower server footprint. So when you put that into your data centers, you're looking at a much smaller number of cabinets, so all your costs come down. The biggest ticket item on any IT bill, generally speaking, in an exchange at the end of the day, is the cost to host. Products, we used to have different systems for different type of products. Again, we're moving now towards more product agnostic exchanges or MTFs, and the idea is you have one application, and depending on the type of product you want to run, you scale by configuration only. And finally, as the key component of that, you need multi-skilled teams that, yes, we still need to do things in a very controlled formal process. We still have to make sure that everything we do is authorised by the regulatory body, but we've got to make sure that we can be a lot more nimble in the way that we deliver platforms. The days of saying it will take 9 months to launch a new product and will cost X million pounds are long since gone. Everything now needs to be done a lot faster. If you're going to react to a competitor, you need to be out there at the same time. My next slide is really looking at how can we also leverage that performance to actually help build the business. So it used to be a case of you only focus on your own system, you're just trying to make it faster. But actually what you want to do is to look at ways of how can you actually retain flow and then capture more. There was a big movement in the last few years around using smart routers as going to different venues to get the best price. Well, actually, that's a very good tool for actually focusing on your own system, using low latency technology to actually look at those various flows of orders that are going to the various pools and saying, well, actually, can we route that to our own exchange, use our own faster algorithms, our own faster pricing servers to actually make sure that we can react to that and come up with the best price ourselves. So start to establish yourself as the better quality pool. Again, we used to look at traditionally citing pricing servers and trading platforms alongside the exchanges. In Colo, it's been a good revenue earner for a lot of the exchanges for a long time. It's very expensive. So again, we're starting to see a backlash against that, where we're now looking at the use of more distributed exchanges, not in the sense of multiple servers, but in the sense of actually putting execution out into different geographical areas, so that basically the exchange comes to the broker and removes that cost. Now, there's a careful thought that we want to make sure that we're still balancing the right level of fragmentation of putting things out into the right place versus actually having good quality consolidated pools in one place. And that's a struggle that we're constantly finding we're having to address. So again, no perfect answer, but we're certainly seeing now a trend of pushing back on some of the high costs that we all used to experience to, well, actually, now we've got this faster technology, can we do things in a better way? The next slide, it comes down to technology wants to be in control of its own destiny. I mentioned the headline of, a lot of us have worked with vendors or suppliers where you put in a change request, you get it estimated, they prioritise it and they come back with the answer, okay, we can fit that into our release cycle Q4 end of next year. Clearly that doesn't work for a business that needs to be able to react very quickly to events in the market. So I think certainly this emerging year is going to be looking at a lot more how do we get control back into the exchange teams, the exchange technology teams, so they can do things under their own steam. We're certainly discussing a lot more source code deals so that they have the option of doing skills transfer and actually making changes themselves. Certainly accelerating delivery timescales. How can we do things in days, weeks, months, still in a controlled way, but at much lower cost and at a rate that actually supports the business. And then finally, in terms of the teams, the days of having huge thousands of people organisations are starting to decline. A lot of the new startups that we've seen in the last few years, particularly the successful ones, they've survived on typically team sizes of 20, 30, 40 people, and probably a much smaller technology team within that has managed to actually create a business that's competed with some of the large incumbent exchanges that have got 10,000 staff. Those lean teams have obviously got to be multi-skilled, they've got to be multidisciplined, they've got to be very formal and rigid in the way that they deliver, but they've also got to be able to think outside the box, be a lot more entrepreneurial, and to be honest, have a passion for the business that they're in. These aren't just back office roles, these are people, technology competent people who want to be part of the business. So finally, in conclusion, I've just tried to pull together the headline points that I think we've covered. Equity markets as we know it, and you can see from the stats that are out there, is declining. It's becoming a low-cost commodity business, so we need to look elsewhere, or we need to be able to do that at a fraction of the cost. Over the next year, as we go forward, certainly the number of exchanges, there's been a number of big headlines in the newspapers recently, will start to decline. But I think the flip side of that, we're going to start to see the new nimble players starting to emerge who've got a particular product that can compete, that's innovative, and will want to do that on their own platform where they've got control and where again they can establish the mainstream business. Exchanges themselves have got to react or die. If they don't do something, they're never going to compete with the smaller businesses. And finally, overall to survive, it's not just a case of a technology problem, it's a case of you've got to actually have products that go out there and meet a market need, that break the Me Too type mould and actually say, yes, we've got something that is worth trading, it fits the market, it meets the market's need now, and you can do it a lot more quickly and a lot faster and for less cost. Okay, that's the end of our presentation. I know we had a website up during the course of this presentation with hopefully some questions. I can see a couple of these that have come through. Maybe the first one for you, Hirander. Let me know the positive trading issues of the European Union.
Yeah, the EU. No, that's right. It's a good question. I mean, we hear a lot of negativity out there with regulators against HFT about effectively the Greek debt crisis and so forth. We all know the negative headlines, and with the UBS issues that UBS and others have had as well. But actually, I am very bullish on European markets as a whole. We've seen a lot of innovation over the last few years. We've seen a lot of competition that's benefited the market as a whole. We spoke about equities, but again, on the back of that, new players coming in, exchanges also innovating, exchanges starting to think outside the box, differentiated products via those new players as well. And I think again, one of the unintended consequences of regulation is that we're going to see that again, because I remember when MiFID 1 came about, everyone was panicking. Oh God, new regulations! How are we going to comply? It's going to cost us. It's going to cost the industry billions of dollars to comply. And then we went away. We did Chi-X. We saw that as a huge opportunity and a gap in the market, and then delivered a successful pan-European liquidity pool. The same way now, the regulations are even broader and all-encompassing across asset classes. That presents a huge opportunity. One, for existing exchanges in Europe to think outside the box, innovate, and secondly, for new players to also come in as well. That's going to lead to a huge benefit for market players. Ultimately, it will reduce some of those systemic risks in the market, even though initially there's always a period of pain when you go through substantial change. And broadly, I think over the next few years, we're going to see a very exciting time in European markets that are going to lead to lots of change, lots of innovation, and seismic shifts in the ways that things are done. And we're going to see winners and losers in this, of course. Some of the existing exchanges have been struggling, hence NYSE potentially being acquired. Others, smaller exchanges in Europe, are looking to see how they create their own footprint and no longer live in the shadow of the larger players as well. and then we'll see new entrants that we haven't necessarily heard about that will launch and announce as well. So it's a very exciting time. I'm very bullish, and may it come on.
And just to add to that, with maybe a technology point of view, we're seeing certainly more and more reuse of experience and good knowledge that's been gained through implementing SDP in the equity world. As the new derivatives type products, as regulation pushes those onto exchange, we can actually make sure that all of the good work we've done in the past can equally apply to those new products. Another one for you, Hirander. And somebody's sent in, how do you differentiate when the UK regulator, the FSA, won't let you?
I think we've seen that to some extent in equities, and I had first-hand experience of that because we, for example, at Chi-X, we had a very innovative dark book or non-displayed book product and very innovative non-displayed order types that were getting liquidity, that were improving the price improvement in the market, yet we had to sort of change those or adapt those products to products that were less efficient, just because the regulators had interpreted that things should be done a certain way and should be uniform across the board. And hence Tony spoke about the commoditization of equity markets, but actually it's not a case of the regulator not letting you. There is plenty of opportunity that I see to innovate beyond equities as well into other asset classes and the way things are done. It's just a case of then ensuring that that conforms with the broader regulatory play around harmonization and around reducing systemic risk, around centralized clearing, and there's still a lot of scope to create new products and create those products in a way that differentiate yourselves. And again, I could talk a lot in detail about this. So happy with whoever raised that question to take that offline as well. But I certainly don't think that we're totally constrained as far as regulation is concerned. Yeah, there are boundaries that we have to work within, but that's expected. And we have that in other jurisdictions as well, whether it's in the US, whether it's individual markets like India as well. And we'll always have to operate in those within those confines. But within those confines, there's plenty of scope for innovation and differentiation.
Okay, we've got two more questions. Will the RSP network survive MiFID II, given it's not an exchange, has market making and broker clients?
Very, very interesting. So this begs the question: are we going to see everything move to lit order books, or whether it's the RSP model or you have the request for quote model, with the likes of Thomson Reuters TradeWeb and other RFQs, will that die away? Absolutely not. I think there's the scope for both types of models, even though there's an open question on how these things are classified. Because if we look at this, in some cases Bloomberg are registering swap execution facilities in the US. When that comes into being, you've got a similar situation here as well. So the need for quote-driven trading doesn't die. Of course, we're going to see liquidity in a central limit order book for more products, but also in less liquid products, you're also going to see the need for a quote-driven model or maybe a hybrid model of some sort as well. Typical example being interest rate swaps types products. If we look at the early tenors, if we look at sort of 2 to 5 years, for example, there's a lot of liquidity on those, there's a lot of market making activity. But then if we go out to 30 years, there's a lot less liquidity in those contracts, and hence a lit order book model isn't a one-size-fits-all. Now, if we relate that back to the RSP network, we're going to see, some of these vendor products get around being classified in their own right, because they're saying, well, actually we're arranging, we're actually facilitating flow as a vendor on behalf of the end customers, the users, who are effectively arranging the deal themselves, which is covered by regulation, and therefore they're covered by arranging deals and investments as far as the FSA is concerned, for example, and the vendor itself is just saying we're a vendor that facilitates. I think that's got to change, because some of these vendors have products that are more and more exchange-like, and in that sense there's an argument to classify these as some sort of venue, whether it's a multilateral trading facility or whether, if the organised trading facility regime in Europe comes into being in that form as well. So we'll certainly see more on that. And if we look at, from a regulatory perspective, we look at this, broadly, we think vendors supplying technology to exchanges or vendors operating platforms like this will be much more under the spotlight, and we're seeing noises of that emerge currently as well.
Okay, the last one I've got is, which emerging regions do you see changing most quickly as their exchanges adapt to the change in market dynamics?
It's a very, very good question. So obviously we've spoken about the ASEAN region, and there's lots of growth there and lots of interest there generally, and we're certainly going to see more there, and there's common product development. Obviously the Chinese market to date has had some barriers to entry, but we're seeing collaboration between the Hong Kong exchange and Shenzhen and Shanghai, and more potentially investment in products that could be offered on each other in a broader market there as well. So we're going to see some movement there. Certainly the Indian market's very exciting at the moment because we're seeing venue competition. There are some restrictions, for example, securities transaction tax is a high cost of each individual trade, and it is a restriction to investors and flow providers coming in. So hopefully we'll see some changes there that open up the market to volume, because it's a very interesting market. If we look at the World Federation of Exchange statistics, the equities flow is smaller than the turnover is smaller than Australia. But then if we look at single stock options, because the state transaction tax is much lower, you've got the one of the largest, if not the largest market in Asia on that as well. So we're going to see developments there across asset classes as well. And I'm very bullish now. We're seeing the early signs of the African exchanges starting to develop and see themselves on more of a world scale, with more inward investment coming into Africa as well. Beyond just the JSE in South Africa, we're now seeing markets like Ghana, for example, have invested in their own infrastructure over the last few years. You've got other markets like Ethiopia that they want to develop and create a new capital market. You've got the Nairobi Stock Exchange in Kenya trying to drive some of that in the region. Nigeria has new management at the exchange, and they're very ambitious now to grow the capital market and have some sort of presence on a global scale as well. Not to miss them out, but they're just key snapshots. So I'm very bullish there. Now, if we look over to Latin America and Central America, obviously we've got the Vespa trying to partner with the CME as the largest market there, but you've got some of the other Latin American markets that are trying to grow volumes and develop products out there as well, and also collaborate with each other, whether it's Chile and Peru, whether it's then some of the Central American exchanges like Mexico develop their own platform in collaboration with, I think it was Carnegie Mellon, forgive me if I'm wrong. And so we're seeing a lot of development there, and an appetite to innovate, whether it's on new products and whether it's technology driving that, and an appetite to control their own destinies, Tony says, rather than be beholden to the larger players as well, which is very encouraging.
Okay, we've had a final one that's just snuck in. I'm not sure if you have an opinion on this one. Do you think European and American regulators should adopt the kind of regulatory regime similar to the Australian one? Are you aware of that part of the world?
Yeah. I mean, it's interesting because you could argue maybe that question infers that the Australian regime is good, but then we've also had noises about ASEC, the Australian regulator, favouring the ASX in terms of certain changes over the alternative venues like Chi-X Australia, whereas others would argue, well, of course, they've opened up to competition now, and the market has scope for further competition, whether it's on derivatives as well, even though that was originally tried a number of years back with the Australian Derivatives Exchange, which wasn't successful and ahead of its time, which a former colleague of mine at Chi-X, Scott Riley, was involved in, and Kathy Lyle, who's a consultant, was involved in as well. But equally, if we look at markets like Australia, ASEC have come out with some I've looked at the algo trading rules and some of the HFC related rules they've come out with recently, and to some extent you could argue that some of those are very stringent, whereas relative to India, that's a very well-regulated market under SEBI, the regulator, the Securities and Exchange Board of India. They came out with, on the 30th of March last year, the algo trading rules, which were more pragmatic, which spoke about what exchanges should be doing as a conduit central area where flow consolidates, and what the brokers should be doing as well. Of course, since then we've had the issue with the NSE and the flash crash there late last year, and there are various controls now that the regulator is looking at. So of course there's a lot of work to be done to make those markets to make those markets sort of flash crash proof, which you can't entirely be, but obviously there are controls you can put in to mitigate that. So I'd say, and this is my personal view, the audience may disagree, I don't think the Australian way is the only way. There are aspects of that regulation that's good. There are other aspects that are too constraining. And so what we need to find is a regime that keeps market integrity, that keeps good flow in markets, but at the same time doesn't suffocate that good flow by over-regulating it. I know it's easier said than done. If you under-regulate, you get issues like the flash crash. If you over-regulate, you suffocate the market. So it's finding that balancing act, which is easier said than done. But if we look at various regulatory initiatives that are happening market to market, I think the answers are out there, and no single regime has got it right thus far.
Okay, we're out of questions. I guess it's left to me just to thank everyone for listening in. Hopefully see you at the World Exchange Congress, and thanks to Terrapin for organising.
Thank you very much, and if you have any other questions, please feel free to get in touch with us.